Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So did you know that more people are buying houses in today's market than ever because of the way things are cooling? But did you also know that people are choosing adjustable rate mortgages because they're almost 0.5% cheaper than your traditional fixed mortgage? If you didn't, stick around. This video is for you. So we all know the housing market has been cooling off and shifting in the buyer's favor. I love this again because you represent the buyers. The bigger the smile on their face, the happier we are for them. One of the big things that makes people smile when it comes to buying a house is their mortgage interest rate. So interest rates have been low for such a long period of time, but recently they went up quickly and they've scared a few people, and so they've been hesitant to buy. But I want to remind everybody there's a trick out there that a lot of people are using now to get their interest rates lower than what the current market is. So when you're seeing marketed rates online or on TV, it usually quotes a 30-year fixed or a 15-year fixed rate. There is another product out there called an ARM, an adjustable rate mortgage. It is a great product. It got a bad name a long time ago during the subprime crash because they were adjustable rate mortgages that weren't tailored, and people were penalized for getting out of them in a certain period of time. That isn't the case anymore. There are no prepayment penalties and things like that on home loans anymore, so adjustable rate mortgages are great products. Let me tell you a couple of reasons why. Number one, the interest rate is anywhere from 1/4 to 0.5% cheaper than your traditional fixed product. So people get a cheaper rate, they get a cheaper payment, they save money. The other thing about that is, adjustable rate mortgages have to be specific to the person, meaning most people actually shouldn't take a 30-year fixed loan. The concept behind that is if it's not a forever home, you don't need a forever loan. So adjustable rate mortgages come really in 3 different options: a 5-year, a 7-year, and a 10-year ARM. So I want to talk about this for a minute and tell you what that means. So adjustable rate mortgages are on a 30-year payment schedule. They're just not fixed for 30 years. So for an example, if you get a 30-year fixed at 4.99%, that interest rate is fixed for 30 years for the life of the loan. If you get a 5-year ARM or a 7-year ARM or a 10-year ARM, you will get a cheaper interest rate by anywhere from 1/4 to 0.5%. But that cheaper interest rate is only fixed for that period of time. So if you take a 7-year ARM, it is based on a 30-year payment. It's just fixed for 7 years versus 30. So let's talk about the risk and the reward. Well, the risk is on adjustable rate home loans. Once that fixed period of time is up, the interest rate can adjust. So I want to talk about this as well. So just because it can adjust doesn't mean that it will adjust. It also means that even though it can adjust up, but it can also adjust down. I've had a lot of clients in the past that had adjustable rate mortgages, and after the fixed period expired, because the market dropped so much and interest rates were lower, their interest rate actually went down for a long period of time, so it benefited them. Most people have concerns and have fears around adjustable rate mortgages when the fixed period of time is up, that their interest rate is just going to shoot to the moon. That's never the case. It can't just go from 4.5% to 10%. It can't go from 4.5% to 20%. There are protective measures in there to make sure that there is not a ton of payment shock to the client. So rarely does anybody not ever do anything with an ARM before it expires. So let me give you an example. I have a 7-year ARM on my house. I refied during the COVID boom. I get all of the reward with very little risk. Why do I have very little risk? Well, most people that take adjustable rate mortgages know that by the time that fixed term is up, 5, 7, or 10 years, they're either going to refinance, they're going to sell, or they're going to pay off the house. So the risk of that product adjusting and the interest rate getting away from them is very, very minimal. These products are usually designed for 2 types of people. People that are buying a house for a certain short fixed period of time. They only know they're going to be in the house for, let's say, 2, 3, 4 years, and so they don't need to take a 30-year mortgage at 5%. They can take a 5-year ARM or a 7-year ARM at 4%. So what they do is they get a much cheaper interest rate, they get a much cheaper payment, and they get all the benefit of getting a cheaper rate and payment, eliminating all the risk. The other type of people that do that, I've got a lot of doctors or people that are, coming to Dallas on a 24-month employment contract, and because they know they're going to be here for such a short period of time, they will also take the adjustable rate mortgage versus the 30-year fixed because it fits their lifestyle. Again, I've said this in a few other videos, but home loans need to be tailored specific to the financial needs and the profile of the individual. Sometimes that's the totality of the profile, debts, credit cards, details, all that kind of stuff, but when it comes to to the actual mortgage term itself and the interest rate, people need to think twice about the specific product that they're choosing. The reason adjustable rate mortgages have not been popular over the past 3 to 5 years is because rates have been so low. They've been in the 2s and the 3s. So it didn't make any sense for a potential borrower or buyer to take an adjustable rate mortgage that was a quarter or maybe a half lower than the market, because things were so low and so cheap, you didn't need to take any risk at all. Now that rates are getting back in the 5s and sometimes in the 6s, if people want to maximize their savings and tailor their loan a little bit more specific to them, a lot more clients are starting to look into the 5, the 7, and the 10-year ARM. So it's something that is becoming more popular. Most first-time home buyers keep their house anywhere from 3 to 5 years. Most second-time home buyers keep their house anywhere from 7 to 10 years. So truth be told, is majority of those folks probably need to be on ARMs anyhow, because they get all the benefit of a cheaper rate. They get all the benefit of a cheaper payment, and usually they eliminate all of the risk because they're out of that house and have gotten rid of that mortgage before that adjustable rate even begins to adjust. On the other side of the coin, we check in with our clients 3 or 4 times a year. We do annual reviews, we do client appreciation parties. So I'm always checking in with clients every single year just to make sure they're in the best financial position possible. One of the things I do check on is making sure people's debt position, their cash flow, how they're feeling about their overall financial position. Do they have any frustrations? But for all of the clients that I have that do have adjustable rate mortgages on them, I make sure and check at them minimum 1 to 2 to 3 years before it even gets to the position of where the adjustable rate could potentially go up, to make sure it doesn't sneak up on them. Other things to think about when it comes to an adjustable rate is, if you have an adjustable rate mortgage and it's a 7-year term, let's say it's a 7-year ARM, you don't have to wait until year 8 to refinance. The Consumer Financial Protection Bureau, which is out there to protect the consumer, says, hey, anything that a consumer can do to put themselves in a better position, there are no penalties, and so you can refinance actually as fast as you want. So let's say you got an adjustable rate mortgage today, and let's say in 2024 something happens and interest rates drop back down to the 3s, maybe even the 2s. You don't have to wait to refinance that mortgage. You can refinance the adjustable rate mortgage at any time. It's just that if you don't refinance it or do something with it after the fixed term expires, then it can go up, but most people usually adjust it, refinance it, reset it, or pay it off way before that time. So there are a ton of big benefits to adjustable rate mortgages. I'm a huge proponent of it. Again, being a certified advisor, I want to make sure that I maximize everybody's home loan to their benefit and make sure that everything's tailored specific to their needs. ARMs are becoming part of the equation again. People understand, wow, I'm not going to keep this house forever. I can get a 5-year, I can get a 7-year, I can get a 10-year ARM, save myself anywhere from 1/4 to 0.5% on an interest rate. That is a lot of money. It's purposeful. It helps people feel better about their financial decision. It helps people feel better about buying a house, and it helps people feel better about their overall payment, their overall debt position. So adjustable rate mortgages are becoming more and more popular. They're going to stay popular for at least probably another 12 to 24 months until we see where the market goes and where interest rates settle. So if you're in the market of buying a house, it's not going to be a forever home. You don't want a forever loan, and these higher rates are scaring you off. You need to look into an adjustable rate mortgage to see the type of benefit and the type of savings that it can take care of you and your family on the rate, the payment, and the savings. So listen, if you found this video helpful when it comes to adjustable rate mortgages, do me a favor, like, share, subscribe. If you got questions about financing, ARM products, things like that, leave a comment below. We promise to get back to you. If you just want to connect with me and talk about your home buying journey, financial strategy, where the market's going, any question, I'm always here for you. Just know that our team is here to help you on your home buying journey. Until next time, stay tuned.